So instead of you sitting down at the computer to accomplish a task, you'll kind of loosely give instructions to an AI tool to perform that task on your behalf. An easy example could be if you're a high school student and you ask one of these tools to write your book report, you're going to do that inside the chat tool. You won't do it inside of Microsoft Word. You'll ask for edits to it through the text interface. And in the end, you can say, make this a downloadable PDF. So that whole process could happen without ever using a Microsoft Word product.
Welcome to Telltales. I'm Mike Nicoletti. Every week, along with my co-hosts Jason Wallace and Hunt Lawrence, we bring you the cash flow memo. Get it at telltales.us. For the next 30 minutes, we're going to dive deep into energy, technology, and healthcare. So download the memo now and get started.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
We won't reveal now which company we're going to take on. We'll keep everyone guessing for 5 or 10 minutes, but we are going to do another of the magnificent 7 or 8 or 9 or however many we get to. Shall we start on Exhibit C?
Sounds good to me.
Exhibit C is interesting because, and we go through this every Wednesday, but there definitely is surplus capacity. And everyone says China slowed down, there's a demand problem. I think that reduction in surplus capacity from 4.4 million barrels a day, mostly Saudi and Emirates, to 3.5. I think what people are saying is they don't see that getting reduced. But the price of oil's going up because Iran is 3 million barrels a day, and there's some chance that Israel, to retaliate for Iran last week launching 200 missiles at Israel, will, one of the ways they'll respond is to put missiles into Iranian export oil facilities. So the price of oil stopped going down and start going up. But depending on what Israel does, that only temporarily solves the problem of that surplus capacity. If we turn to Exhibit B, which does have oil prices on the bottom along with gas prices, you can see that as of last Thursday, which is when these prices, a couple things happened. First of all, the price of WTI for the near month, the prompt price, was up to 72. But the other interesting phenomenon is the backwardation is greatly reduced. In other words, the 26 price was 68. So I suppose what people that buy and sell futures and oil are saying is that if this got started, it may just persist for a long time, so that there would be some reduction in the amount of oil coming from Iran. As far as natural gas is concerned, it's begun to get a little better. You can see the near month was 291. The 25 and 26 numbers have been pretty steady in that 340, 350, 360 range. Absolutely crucial that gas production doesn't go up more than a couple of Bs a day. You see the projection here is 105 versus 102. And also crucial that power demand continues to increase by, as you can see, 1.5 Bs a day. I think that's pretty set. As far as LNG exports, it's disappointing because 24 is 13 Bs a day, which is the same as 23. The 15.5 for next year, pretty well locked in based on LNG projects that are nearing completion. Natural gas does look a little better, finally. Exhibit A, the latest announcements kind of covered in the Wall Street Journal editorial today, is that the deficit was 1.8. I had looked at the latest CBO numbers based on 11 months, and it was 1.9. I have to try to figure out how they how they saved $100 billion. Once again, neither side is talking about what needs to be done, which is to reduce that all other, or at least not have it increase, get it on a downward path. All other is 910 billion before COVID in 2019, and in 24 it's supposed to be 1.44, and during COVID it reached almost 3 trillion. But it just can't go all the way back to 910 billion, but it can't be maintained at the 1.4 trillion. It just has to go down. Any other macro comments, Mike or Jason?
Well, I guess we did see the 10-year tick above 4%. I don't know if that's held at that spot, but kind of, we've been talking a long time about the fact that just because the short rate goes down doesn't mean the long rate's going to go down too. And the market probably just got ahead of itself, and it's now back up to a little over 4.
Yeah, the 2-year and the 10-year both trading around 4%. I think that's up about 30 basis points for the 10-year. It's a very strong employment report last Friday, and there'll be a consumer price index tomorrow morning. We'll have to see. I personally think that the demand for the U.S. government to borrow money to cover its deficit and also to cover continued reduction in the Fed balance sheet will result in something approaching a 2% real interest rate. So if your inflation rate really is 2%, 2 plus 2 would be 4. Most people think that a 2% real rate is way high. That's not going to happen. I believe that interest is a price. Interest rate is a price. Price is determined by supply and demand. There's a huge demand by the government to borrow money. So I think the 2% real rate would be appropriate. And I know Jason agrees with me. I think Mike does too, but we'll see what happens.
Yep, I think so.
We're going to switch to the front of the memo, but every page here has been updated to 6 months. And I do that on the weekends. If Mike and Jason were doing it, it'd happen much quicker. But I want to sit and look at the 10Qs and really think these things through, not just change the numbers. But happy to say every page is updated to 6 months ahead of the first reports coming in for 9 months, which will be, I think, Thursday or Friday. People like JP Morgan and Wells Fargo announced their 9-month results through September 30. One of the things that I noticed in looking at this, before we get to the front of the memo, I want to call out a couple of things. On page 20, Uber has free cash flow. We're not going to talk that much about Tesla this week because I think their day on the robotaxi is it next week?
Tomorrow, I believe.
Tomorrow. I think we want to get into Uber more after that event. But Uber does have free cash flow, and they are increasing their cash flow. So, that we'll deal with. You don't see anything else on page 20. Harrow, which is a healthcare investment by Mike and Jason, is making its way in the world. So any news on Harrow, Jason?
There actually is. So the third drug of their kind of big 3 that they're bringing to market received FDA authorization last week. So this one, it's called Triessence. It's a anti-inflammatory injectable. And they actually acquired it from Novartis, who was no longer making it due to the difficulty of manufacturing and the smaller market relative to their size. So Harrow acquired it. And as part of the process to bring it back to market, they had to complete 3 manufacturing test runs of their new process and have the FDA verify quality of those test batches. So that was completed last week. They got authorization kind of faster than maybe we were expecting and maybe the company was expecting. Since it occurred so quickly, they're now able to sell the remaining portions of those test batches into the market. They claim there's an existing demand for it since it was already in the market and kind of removed, even though the demand was there from ophthalmologists. So if you remember back and you look at the numbers in the sheet, that Harrow is projecting $200 million in revenue this year. They're already well ahead of that pace. And then bringing this drug back to market in Q4 was not in their estimates. So they're doing well to outpace their expectations.
And something to add to that, we've talked before about the S curve of adoption when it comes to pharmaceutical drugs, but mainly the growth is slow in the beginning, and at some point the network of doctors that get comfortable with prescribing it grows to a point where the growth is kind of accelerates. It's not out of the question that this thing kind of jumps right into the steep part of the curve because it was on the market before. The doctors that used it want it back on the market, supposedly.
Right.
So we kind of expect quite the ramp.
Yeah, interesting. It's interesting. Another thing I noticed updating these on page 18, two companies. Freeport is a very large copper producer. I think it's the world's largest, and it does have free cash flow, and it's making its way in the world. And the theory is that EVs and other transition energy require more copper. Albemarle is very large producer of lithium. Look at the difference. I mean, lithium has just crashed. Freeport has $3.7 billion of free cash flow, and Albemarle has almost $2 billion of negative cash flow. So here are two commodities, lithium to make batteries for EVs and for backing up solar. And, just lithium prices are terrible. Just interesting that you'd expect them both to be doing better. One's holding in there and one's doing very poorly.
And one of the things we noticed with Albemarle back when lithium prices were skyrocketing is that those prices were not translating into additional profits for Albemarle because the majority of their production was on fixed price contracts. Well, over that period, they began rolling their customers onto spot price based contracts. And unfortunately for them, that means that they're not necessarily going to be pricing in the ability to cover their operating expense. So
right.
It's, there's a reason that they were on fixed price contracts before. You can see that they've sort of put themselves in a pickle with the market rate prices.
Yeah, interesting. Next one would be page 15. Pfizer's picked up a value investor, Starboard. I'd be interested in what Jason thinks. I don't see that Pfizer's that poorly managed. I mean, I guess they get criticized for the acquisitions they've made, which may not be working out. I mean, is that basically the argument, Jason?
And I'm not even sure if that's the case. I think maybe they mismanaged expectations coming out of COVID, but I agree, it's not.
Here's an analogy. It's hard to squeeze water out of a rock, even if you're really strong. They have a great distribution network, but if you don't have drugs to sell through that network, then it's going to be challenging. And they've got some patent cliff issues. Mm-hmm. Yeah, they made a bunch of acquisitions, but because everybody, and this goes for everybody, this goes for BMS, all the other majors that have looming large drugs coming off of patent, they all are trying to fill that pipeline. And there are lots of biotechs with promising stuff in late stage or phase 3 trials that are happy to exit now and not bear the risk associated with a phase 3 failure.
And biotech valuations were depressed, along with the rest of Moderna and Pfizer being punished for losing their COVID revenues. So the whole market was down. So maybe those acquisitions could turn out to be pretty smart.
Yeah.
Just on a timing basis, yeah. Okay, let's take a quick break for a message from Oak Cliff Sailing.
Hello, everybody. It was a busy week last week. We were on the JV66 Temptation, sponsored by Art Santry, racing the Maxi North Americans. That was alongside the ORC World Championships. Gwen Fragaman, a woman, won her class on Interlodge as a helmsperson. So that was great. Next week, we have the Women's Sports Foundation, where Kimbra and Mark Walter are going to be honored, and they are the sponsors of Courageous. So we've got a lot of women power going on. Speaking of that, I am headed down to Annapolis tonight to speak to the Annapolis Yacht Club Women's Racing Group. And then tomorrow I'll be beating the tracks at the trade day at the Annapolis Boat Show. Ethan Johnson will also be down there, and he's our training program director. He's going to be doing some recruiting and some marketing to get out the word of all the exciting things we happen at Oak Cliff, which include next weekend's, or this coming weekend's, grade 5. It's a clinic and a little bit of racing on Saturday and a lot of racing on Sunday. Anybody who's in the area who wants to get some practice in umpiring, I will be coaching you over the VHF. We kind of copy Gary Jobson and do a little bit of commentary on the VHF 6.9 so everybody can learn, including the sailors. One of the unique things that we do here at Oak Cliff. And just one more reminder, I will be going out on the road this winter and coming to the areas around the country to talk about what we do, how we can help you, some entertaining, some counseling, some coaching, and that's going to be a preview of what I'm speaking tonight at Annapolis Yacht Club. See you soon.
And now back to the show.
I think we can go to candidate to evaluate weak spots in their armor. Now, we have to say these are good companies. We've done Apple, Google or Alphabet, Amazon, and Meta. Please, 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 if you have a position, don't sell the position just because we are looking for a soft spot in their competitive position, their operations. And if you have it on a list, a buy list, at lower prices or whatnot, keep it on the buy list. But this Wednesday's entity is Microsoft. And Mike and Jason own Microsoft. And you'll remember Apple got some negative comment because they had kind of weakish product day. Google, the discussion was how threatened is search by AI. Amazon, I think the commentary was that it was hard to find weak spots in Amazon's business, whether it be cloud or their warehousing and sales and whatnot. But I don't know which one of you wants to start on Microsoft. I suspect, and Mike and Jason, I don't think agree with this, but I suspect that Microsoft, having had an early start with their investment in OpenAI and putting out their Copilot product, looked like they were ahead. But we discussed Meta last week, and it seems to me that Meta with their Llama product is giving them a run for their money. But with that commentary, which is not all I feel able to, and I want Mike and Jason to disagree or with anything I've said. With that, I think we turn it over to Mike and Jason.
Okay, so I want to start and just lay the sources of cash flow out, and then Jason and I will kind of break down the way we are looking at the risks. Microsoft has two main franchises that are currently practically unassailable, and we want to really break down where that could fall apart and how computing changes with this paradigm shift to artificial intelligence. But yeah, let's first start with the free cash flow. You'll see on page 1, Microsoft's doing about $70 billion in free cash flow. The majority of that comes from the Microsoft Office franchise. Our estimate is that it's probably a little north of $40 billion just from Microsoft Office that is pure free cash flow. The next largest chunk of profits comes from Windows, and that's whether it's Windows Server, Windows Pro, or Windows Consumer, that brings in about call it $20 billion in free cash flow. The remaining of that 70 comes from Azure. So before we get into the AI stuff and all that, let's cover Azure real quick. And Jason, jump in if you disagree. But broadly, we see Azure competing against Google Cloud and mostly Amazon, and now more recently Oracle, in a relatively competitive market. The main profit drivers are shortage, and depending on especially within GPUs, shortages in GPUs create pricing power broadly. But in the absence of those hardware shortages, profits shouldn't be as high as they are right now. I mean, their cloud business, which if you ever read their quarterly or annual reports, you'll find they lump their revenue into 3 different categories. Azure falls in the intelligent cloud business. It has an operating income percentage of 47%, which is extraordinarily high, especially when you consider it has some enterprise consulting services looped into that part of the business. The categories broadly, just as a side note, are basically set up so as to not make it so obvious that the monopoly products are so ridiculously profitable. So that brings us to Windows and Microsoft Office. And Jason, you want to lay out the kind of where we see why those things have been so profitable up until now, and then maybe we can jump into the risks as to how AI changes them.
Yeah, I guess starting with maybe a history is, Microsoft was really born, and their product suite was really born out of the shift from mainframe computing to personal computing. The next shift was personal computing to mobile computing, and they had Windows Mobile, but they've largely, completely missed the boat there. We're kind of beginning this new transition into AI, and we'll talk about what that maybe looks like. But really what's worked for them is the interoperability of file formats with Office and the Windows ecosystem. So Office was exclusively on Windows for a while. It was the by far the best productivity suite of products. If you wanted to share those with other users, whether for personal use or largely in business, you had to have that piece of software to open the .doc file, for instance. So interoperability was really key here, and they really took the market with their productivity suite of tools. So Office, and then running on top of Windows. Where interoperability wasn't a key driver was in the server market. So Windows Server plays there, but they're really a small portion of the market share. There's Linux kind of owns the server market. It's an open source product, and its differentiator was survivability. From it had an order of magnitude better uptime and ease of maintenance than running a Windows server. So they kind of end up dominating the server market operating systems. Is that what you're looking for, Mike?
Yeah, totally. I mean, you call it interoperability. I'd say lack of interoperability, actually, because you had to have Microsoft software to open those documents and edit them.
Right.
And the question about the future that you have to ask yourself when you say, is this franchise going to persist into the future, is will file format interoperability or lack thereof enable them to maintain this franchise? And our broad expectation is the risk is that it won't. There's lots of, we won't go too far into detail here, but there is a chance that having an AI layer over your operating system will provide opportunities for interoperability that we don't have today broadly. So if Jason uses ChatGPT, let's just assume ChatGPT is his AI operating system and mine is Anthropic. It's very likely that we can send information to and from each other, and the AI will be perfectly capable of retrieving it and presenting to us in a format that the way that we want to. So file format interoperability, not likely much of an issue.
I mean, you could even today with the tools, you could print a document, scan it, and then feed the image into one of these AI systems, and it'll read it, interpret it, and present you the text that you can edit.
Mm-hmm. Yeah. So I think that's the risk to be aware of. And you're talking about, in just the case of Office, that's $40 billion in free cash flow. So we've talked about the risks with Apple, that they've got $20 billion of cash flow on the line coming from Alphabet. There's a lot of cash flow concentrated in the Microsoft Office suite.
What about enterprises wanting to stick with Office because they want to try to maintain security or not be as open to people hacking into their systems? Is that part of Microsoft's advantage here?
Well, I think they certainly have an advantage rolling into this. Broadly, our expectation is that artificial intelligence is a sustaining innovation, meaning the value will accrue to incumbents rather than disruptors. And the question, and I think the question you have to ask is does the dimension of value change? And Jason described what happened within servers. It used to be people use Windows Server for most server applications, but Windows Server was terrible. I mean, the uptime and reliability was not high enough for the use cases that were being presented to it. So Linux servers, which were practically free, you could buy certain versions that had extra stuff in them, but less expensive, much higher uptime, competed on a different dimension, in that case reliability, rather than
security.
Yeah. So I think it's the question is, does the dimension change? That's what's important to the end user. So, it didn't really matter that Microsoft lost the Windows Server market because they absolutely dominated the desktop market. And the desktop remained the computing platform on which business gets done. So I think their move to, for all practical purposes, acquire the IP of OpenAI gives them the ability to build an AI orchestration layer over Microsoft Windows, which gives them the ability to essentially sustain the current paradigm. And the only way somebody's going to disrupt that, I think, is if they come with a completely different solution that has value on a different dimension. And it's likely going to start with a small group of users, a very, innovator's dilemma style disruption. But for the time being, it's very likely that just the complexity and the costs involved with implementing these types of AI systems, Microsoft's in a very good position to do that. Another risk that they have associated with this is execution. So I think,
I guess since we're poking holes, I would kind of weave a story about what the market's starting to call AI agents. So instead of you sitting down at the computer to accomplish a task, you'll kind of loosely give instructions to an AI tool to perform that task on your behalf. And I guess an easy example could be if you're a high school student and you ask one of these tools to write your book report. It's maybe already examined every page of this book that's been published, and it can give you a 6-page summary. You're going to do that inside the chat tool. You won't do it inside of Microsoft Word. You'll ask for edits to it through the text interface, the chat interface, and in the end, you can say, make this a downloadable PDF that I can turn in as my assignment. So that whole process could happen without ever using a Microsoft Word product. So that's a potential where you could eliminate Office. I've seen some interesting stories that someone says Excel will never be eliminated from humanity. So maybe we won't get away from that one, but parts of Office.
Well, in some ways, Microsoft Windows Server does still exist, and they do still sell it.
Oh, yeah.
And I think some of the airlines that run some of their systems on it are probably wish they would have got off of it sooner. But but yeah, most of these things never totally die, but they do become buggy webs.
Linux is out in the public market, right? I mean, no one really makes money from Linux or royalties or anything, do they?
Red Hat is a company that they'll sell you an enterprise version that they kind of add security to and consulting services around. But yeah, it's free to download otherwise.
But didn't Oracle try to do, right? Because they acquired some piece of it and then tried to exert some control over it, and it didn't really work out.
I think that's what I remember. They tried to make a case that they were due some royalty income, but I think they failed.
Right.
Yeah.
I think Red Hat was acquired by IBM, wasn't it? So kind of one of IBM's efforts to remain relevant or replace their cash flow that they lost from mainframes.
Yeah, this would get off on a tangent, so maybe another time we can talk about how maybe we're going back that way. But
yeah,
we're over time already. So
yeah, we're over time. We were keeping it a secret what we do the following Wednesday, but with the Robotaxi Model 2 call tomorrow, rest assured we'll be talking about Tesla next Wednesday. And with that, everyone be well and stay healthy, and we'll be right back here 7 days from now. Take care.
The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the hosts nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to and no reliance should be placed on the fairness, accuracy, timeliness, or completeness of this information. The hosts and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future and may or may not hold positions in the securities mentioned.